You watched the silver rally. You read the headlines about historic records. You saw the charts climbing and thought you understood the story. But the real narrative wasn't on the trading screens. It was in the shipping manifests, in the supply contracts of solar factories, and in the structural deficits that nobody can reverse. Silver hit $83.62 per ounce in December 2025, an all-time high. In January 2026, it's trading above $72, up 145% year over year. But it wasn't speculation that caused this. It was physics. It was the brutal mathematics of a commodity where industrial demand now consumes 50% of annual production versus just 10% a century ago. The world produced approximately 850 million ounces of mined silver in 2025, plus another 150 million from recycling. Total demand exceeded 1.2 billion ounces. This isn't temporary tightness. It's the fifth consecutive year of structural deficit of approximately 200 million ounces annually. Every year, the market consumes more silver than the Earth can deliver. While you slept, the global economy electrified. Solar panels, electric vehicles, advanced electronics, and renewable energy infrastructure became the planet's largest silver consumers. There is no substitute for silver's superior electrical conductivity in photovoltaic cells. There is no alternative in critical thermal applications. Physics doesn't negotiate. The solar energy market is projected to reach $495 to $12 billion by 2034. Every watt of that capacity requires silver. Every electric vehicle on the road carries silver components. Every modernized grid consumes more metal. Global decarbonization isn't a reversible policy. It's structural demand that only accelerates. Here's what analysts didn't tell you. Only 25% of global silver comes from primary silver mines. The other 75% is byproduct of base metal mining like copper, zinc, and lead. When silver prices rise, primary producers can't simply increase output. And byproduct producers don't respond to silver price signals. They respond to the base metal. This means the supply mechanism is broken. In normal commodities, high prices stimulate new production and balance the market. In silver, record prices can't summon enough metal because the supply infrastructure wasn't built to respond. Deficits persist even with silver at $80. Imagine what happens when industrial demand accelerates in 2026. Silver exchange traded funds recorded massive inflows in 2025. Institutional investors finally realized what industrial strategists already knew. Physical silver is becoming scarce. Every ounce that enters an ETF vault is an ounce that never reaches a solar factory. The financialization of silver is competing directly with global electrification. India saw silver surge 27.13% in December 2025 alone, from $188,000 to $239,000 per kilogram. Asian markets are pricing a reality the West is still processing. Physical commodities and structural deficit don't obey the rules of financial assets. When atoms run short, paper doesn't matter. The Federal Reserve began easing monetary conditions in 2025, reducing real yields. This removed the opportunity cost of holding metals. But it wasn't monetary policy that drove silver to historic highs. It was the collision between fixed supply and inelastic industrial demand. Policy merely removed the last resistance. Analysts project silver could reach $100 or more in 2026. But these projections still assume supply will respond. They assume recycling will increase. They assume substitutes will appear. The history of industrial commodities proves these assumptions are dangerously optimistic. When solar panel manufacturers compete with electric vehicle makers for scarce metal, price finds no gentle ceiling. Here's the mechanics you need to understand. Industrial demand cannot be destroyed by price in the short term. A solar panel manufacturer with supply contracts can't simply stop the production line because silver got expensive. He pays whatever is necessary or breaks contracts. The price elasticity of industrial demand is near zero until price levels force complete product redesigns. Redesigning a photovoltaic cell to use less silver takes years of research, testing, and certifications. Reformulating automotive electronics takes entire development cycles. Meanwhile, demand continues, contracts continue, factories continue, and the 200 million ounce deficit continues draining global stockpiles. Registered inventories at major Western exchanges are already under pressure. Every time a producer withdraws physical metal to deliver against industrial contracts, those stockpiles shrink. And unlike gold, which circulates in financial cycles, industrial silver is consumed. It's destroyed in applications that will never return to the recyclable market at relevant scale. Silently, while everyone watched futures trading, Asian buyers began accumulating silver concentrates directly from producers. This metal never touches Western exchanges. It's refined in Asia, consumed in Asia, and remains in Asia. The geography of silver supply has shifted, and the Western pricing system hasn't yet internalized this reality. China, the world's largest solar panel manufacturer, doesn't depend on COMEX or LBMA pricing. It built vertically integrated supply chains that capture silver at the concentrate stage, long before it becomes investment metal. This is structural leverage. When refining capacity and industrial demand live on the same continent, metal never needs to cross oceans. What does this mean for physical silver holders? It means you own an asset whose supply chains are fragmenting. The global arbitrage system that used to balance prices between London, New York, and Shanghai is developing friction. When metal flows predominantly in one direction and industrial demand competes with investment demand, markets decouple. There's a specific date investors have marked, January 27th, 2026. Shareholders will vote on a major acquisition in the sector. The technical details matter less than the context. Consolidation is happening across the silver supply chain. Smaller producers are being absorbed, processors are merging. When industries consolidate under price pressure, it's because competition for raw material became existential. You need to understand the difference between a financial silver rally and a structural silver rally. In 1980, the Hunt brothers piled metal in a speculative scheme. When it collapsed, underlying demand didn't exist to sustain prices. Today, demand exists. It's measurable, it's growing, and it's physically impossible to satisfy at current production levels. Global electrification isn't reversible. Once countries install solar capacity, they don't dismantle it. Once vehicle fleets electrify, they don't revert to internal combustion. Once grids modernize, they don't regress to analog systems. Each of these transitions locks in decades of industrial silver demand. Forecasts for 2026 suggest industrial demand will remain elevated, but elevated doesn't capture the urgency. Governments and corporations have prioritized decarbonization. They signed climate agreements. They issued green bonds. They committed to electrification on specific timelines. These aren't vague aspirations. They're contractual obligations requiring physical silver. Meanwhile, mines are depleting. Silver isn't a rare metal in Earth's crust, but economically viable deposits are limited. New mining projects take a decade from discovery to production. Projects approved in 2026 won't deliver metal until the mid-2030s. The deficit you're seeing now is structurally impossible to correct in the short term. Recycling can't save the market. Silver in solar panels is embedded in systems designed to last 25 to 30 years. Silver in electric vehicles doesn't return to the recycling cycle until vehicles are scrapped decades later. The recycling rate of silver from industrial applications is a fraction of the rate from jewelry or silverware. The metal is functionally lost to the economy for generations. Technical substitutes don't exist at scale. Yes, researchers are exploring alternative conductors for solar cells. Yes, engineers are trying to reduce silver loading per panel. But these innovations take years to move from laboratory to mass production. And even when successful, they reduce silver intensity per unit. They don't eliminate absolute demand, which continues growing with volume. Sovereign wealth funds and institutional asset managers are finally allocating to physical commodities as hedges against energy transitions. This is new. For decades, silver was treated as second-class monetary metal or retail speculation. Now, macro strategists recognize that controlling physical commodities and deficit offers strategic leverage in an electrified economy. You need to see through spot price. The price you see on screen is for futures contracts traded on exchanges. It's price discovery for hypothetical future deliveries. But when industrial buyers need physical metal now, they pay significant premiums over spot to secure delivery. These premiums don't appear on price charts. They appear on manufacturers' financial statements as inflated material costs. Physical premiums are the signal that paper market and physical market are divorcing. When the spread between futures contracts and real metal widens persistently, it means the delivery system is under strain. Buyers no longer trust that paper contracts will convert to bars, so they pay extra to secure real atoms. This is the environment where liquidity crises develop. Not financial liquidity, physical liquidity. There may be billions in notional silver contracts trading electronically, but if only a fraction demand physical delivery and inventories are inadequate, the clearing system enters crisis. Exchanges have already altered delivery rules in the past when confronted with physical squeezes. Expect more interventions in 2026. These interventions don't fix markets. They confirm markets are broken. When regulators need to suspend trading, alter margin requirements, or modify delivery specifications, they're admitting the pricing system has become disconnected from physical reality. And each intervention further erodes confidence that paper contracts are worth anything. Here's the cold calculation. If you own physical silver and industrial demand is outpacing supply by 200 million ounces per year, your metal is becoming scarcer every day that passes. Not relatively, absolutely. Global above-ground silver inventories are shrinking while consumption increases. This is the definition of vanishing supply. Manufacturers are already extending lead times for silver-intensive products. When you hear about delays in solar panel deliveries or automotive electronics, part of that is silver scarcity forcing slower production. Companies don't announce, "We're out of silver." They say supply chain challenges. But the mechanics are the same. They can't get enough metal to run production lines at full capacity. Capital has no feelings. It flows to where returns are. For years, capital avoided physical commodities because financial assets offered better risk-adjusted returns. That calculation has changed. When physical commodities are in structural deficit and are critical inputs to global megatrends, capital reallocates. The money following silver in 2025 wasn't speculative. It was strategic. The gold-silver ratio, which measures how many ounces of silver by 1 ounce of gold, compressed dramatically in 2025. Historically, it oscillated between 61 and 80.1. When it tightens to 40.1 or less, it signals silver is fundamentally outperforming gold. This happens when industrial demand for silver exceeds monetary demand for gold. You're witnessing that transition now. Gold is predominantly monetary. Central banks hoard it. Investors hold it as store of value. Silver was monetary. Now it's industrial. And industrial demand, when driven by mandatory technological transitions, is more powerful than monetary demand because it can't be switched off by sentiment changes. Factories either produce or close. Some analysts still treat silver as poor man's gold or retail inflation hedge. They're looking in the rearview mirror. Silver in 2026 is critical input for electrification, digitalization, and decarbonization. It's semiconductor metal, it's photovoltaic metal, it's electric mobility metal. Those who still view it through monetary lenses have missed the plot. There are only business days before quarterly reports from major producers and manufacturers are released in January 2026. These reports will reveal production guidance, input costs, and inventory dynamics. When solar manufacturers report compressed margins due to silver costs, when EV makers report delays due to component bottlenecks, the market will finally connect the dots between commodity deficits and corporate profitability. Expect guidance revisions. Expect supply securing announcements. Expect strategic partnerships between manufacturers and miners, bypassing spot markets entirely. When industrial buyers lose confidence in public markets to deliver critical commodities, they build private chains. This fragmentation has already begun. You're witnessing the commoditization of energy transition. For years, it was abstract concept, political goal, PowerPoint presentation. Now it's physical tons of metal moving from mines to factories to deployed products. And the world discovered it doesn't have physical infrastructure to execute the transition at the speed promised to investors and voters. Governments face brutal choice. Slow down electrification commitments or pay any price for critical inputs. They'll choose to pay. Stalling climate goals is political suicide after years of rhetoric. So they'll subsidize buyers, protect suppliers, and ensure factories keep running regardless of input cost. This puts a floor under commodity prices the market hasn't yet priced. The narrative you're hearing in conventional financial media is months behind. When CNBC reports silver hits record, the real move already happened. Strategic allocations were already made. Supply contracts were already signed. Informed capital already positioned. Price news is lagging symptom of structural changes that occurred silently while everyone watched other things. Here's what comes next. In coming months, you'll see more volatility, more headlines, more experts offering opinions. Ignore the noise. Focus on physics. Focus on flows. Focus on tonnage. When someone shows you a technical chart of silver, ask, where's the physical metal? Who owns it? Who controls it? If they can't answer those questions, they're trading abstractions. Physical silver holders own something that can't be printed, can't be legislated into existence, and can't be substituted by algorithms. They own atoms whose utility increases with every solar panel installed, every electric vehicle sold, every kilometer of grid modernized. In an electrified world, silver isn't an investment, it's infrastructure. The world changed. Demand structurally exceeded supply. Supply chains fragmented geographically. Financial markets still price old reality while physical reality already evolved. Capital recognizing this disconnect is silently repositioning. Capital that doesn't recognize it will be left holding paper claims on metal that will never materialize. You had time to prepare. You had data. You had warnings. The window isn't closed, but it's narrowing. When global manufacturers begin reporting supply failures publicly, when governments begin invoking emergency allocation powers for critical commodities, when exchanges begin modifying contracts to avoid delivery crises, it will be too late to act at reasonable prices. This isn't about market timing. It's about structural positioning in a commodity whose supply can't grow fast enough to meet demand that can't be destroyed. It's about recognizing that global technological transitions aren't negotiable, and silver is on the critical path of every single one. It's about understanding that whoever controls physical commodities and deficit controls leverage over entire economies. The remaining days before the next catalysts aren't for speculation. They're for decision. Either you recognize silver stopped being a trade and became strategic allocation, or you continue treating it as speculative asset and lose when the market reprices violently. Mechanics don't lie. Physics doesn't negotiate. And metal that doesn't exist can't be delivered no matter what the contract promises. What's coming isn't a rally. It's structural adjustment to new reality, where critical physical commodities command pricing power because they're physically scarce in a world that decided to electrify everything simultaneously. This adjustment won't be gentle. It won't be gradual. It will be a series of price shocks forcing industrial redesigns, allocation rationing, and political interventions. You've been warned, not by alarmists selling newsletter, by the data, by the deficits, by the flows, by the brutal mathematics of 200 million ounces of annual scarcity colliding with inelastic industrial demand. The rest is just watching the structure that was already built collapse under its own weight, while a new system emerges around those who control atoms, not contracts.